Alright, what's up, money misfits? Today, we're diving headfirst into how the ultra-rich, the elusive 1%, practically sidestep the tax man using strategies so cunning, so legally shady, you'll wonder if they're playing a different game entirely. Spoiler, they are. Forget your W-2 struggles, these folks operate on a dimension where debt isn't a burden, but a superpower, and taxes are suggestions. We're talking generational wealth, built on clever accounting and legislative lobbying. Strap in, your perception of fair play is about to get a serious reality check. First up, let's dismantle the myth that all debt is bad. For the 1%, debt isn't a burden, it's their most potent weapon. They don't use their own money to buy appreciating assets. They use OPM, other people's money. Want a massive apartment complex or a new business? You take out a massive loan. Why? Because the interest on that loan, if it's for investment or business, is often tax-deductible. Imagine borrowing $10 million at 5% interest for commercial property. That's $500,000 in annual interest payments. Guess what? That $500,000 reduces your taxable income. So, while the property appreciates like crazy and spits out rental income, you're also telling Uncle Sam, hey, I'm spending $500,000. It's like getting a tax discount just for being leveraged. They're getting wealthier by taking on debt, reducing taxable income, and letting assets grow. Meanwhile, you're stressing over student loans. Now, let's talk about depreciation, a masterpiece of accounting wizardry. You buy $1 million building. The land doesn't depreciate, but the building itself, according to the IRS, loses value over time. Even if it's actually appreciating. So, you deduct a portion of the building's value as an expense every single year, without spending a dime. It's a non-cash expense. For example, a $1 million building might let you depreciate $25,000 to $30,000 annually. That $30,000 reduces your taxable income. So, your property makes rent, goes up in market value, and you report lower profit, or a loss, on paper, thanks to this phantom expense. Pros use cost segregation to accelerate depreciation, taking larger deductions faster. And it's not just buildings. Think business expenses, private jets, yachts, lavish dinners, country club memberships. Many are legitimate write-offs. My Gulfstream G650. Essential for business travel, obviously. All perfectly legal, because, business. Alright, brace yourselves, because this is where the 1% truly flexes. Most of us earn ordinary income, taxed federally up to nearly 40%. The rich largely make money from capital gains, profit from selling assets. Hold these assets over a year, and they're taxed at a much lower long-term capital gains rate, currently topping out at 20% for highest earners. Almost half the ordinary income rate. Their strategy? Buy assets, hold them, let them grow. But here's the real cheat code, the step up in basis. When you die, your heirs inherit your assets. The kicker, the cost basis of those assets steps up to their market value at your death. Picture this, you bought a stock for $10, now $100. Sell it, you pay capital gains on $90 profit. Mr. Moneybags bought stock for $10 in 1990, now $10,000. If he sells, he pays tax. But if he holds it until he dies, his kid inherits it with a new cost basis of $10,000. If the kid sells for $10,000, profit? Zero. Zero capital gains tax. The entire gain from original purchase to death is completely erased for tax purposes, allowing dynasties to be built. Wealth passes down tax-free, generation after generation, without triggering a capital gains event. They never sell, they just borrow against the assets, tax-free, and pass them on. It's a legal loophole ensuring multi-generational wealth without the government getting its cut of appreciation. Beyond the step-up, the ultra-wealthy use lawyers and planners to construct impenetrable fortresses around their money using trusts and complex estate planning. Irrevocable trusts, assets placed here are no longer your assets, excluded from your taxable estate, avoiding estate taxes, which only apply to multi-million-dollar estates. Grant or retained annuity trusts, grats put appreciating assets into a GRAT, take an annuity payment. Any appreciation above a certain rate inside the trust goes to your heirs tax-free, removing future growth from your estate. Like taxing the original box, not the rocket's trajectory. Family limited partnerships, FLPs put assets into an FLP, give shares to your kids. Because shares are in a private, illiquid partnership, they can be discounted for gifting. So, a $1 million share might be reported as a $600,000 gift for tax purposes. Sneaky. Charitable remainder trusts, CRTs donate assets to a CRT, get an immediate tax deduction, receive an income stream for life, assets grow tax-free, then the remainder goes to charity. A tax break, income, tax-free growth, and heirs avoid estate taxes. A win-win-win, unless you're the tax collector. Let's talk about the carried interest loophole, cherished by private equity and hedge fund managers. When these fund managers make money for investors, they get a cut of the profits, often 20% or more. This performance fee or carried interest is basically their salary. But instead of being taxed as ordinary income, a significant portion is taxed as long-term capital gains. This matters because long-term capital gains are taxed lower than ordinary income. So, a hedge fund manager pulling in $50 million a year from carried interest isn't paying 37% or 40% federal income tax, they're paying 20%. That's a massive discount on compensation, thanks to a loophole debated for years but persistent in the tax code due to effective lobbying. It's essentially a gilded handshake from the government to the titans of finance. So, let's wrap this all up into the ultimate playbook for the 1%. It's elegantly simple, brutally effective, and mind-bogglingly legal, the buy, borrow, die strategy. 1. Buy, acquire appreciating assets, stocks, real estate, businesses, using as much borrowed money, debt, as possible, deducting interest where applicable. Let assets grow for decades, ideally never selling. 2. Borrow, need cash for your lavish lifestyle. Don't sell and trigger capital gains. Borrow against them. Loans using appreciated assets as collateral are not income, so they're completely tax-free. Assets grow, unencumbered by capital gains, providing tax-free liquidity. 3. Die, when you shuffle off this mortal coil, your heirs inherit those massively appreciated assets with a step-up in basis to current market value. Decades of appreciation. Wiped clean for tax purposes. They can sell immediately with little to no capital gains tax, or continue the cycle. This strategy ensures wealth compounds tax efficiently across generations, creating dynastic fortunes. It's not about hiding money, it's about structuring life and investments so the tax code works for you. You're probably thinking, how is this even fair? The cynical answer. Because those who write and influence tax laws often benefit from these provisions. Lobbying ensures these loopholes persist. It's not illegal, it's deliberately structured. Can you replicate this if you're wondering about avocado toast? Probably not to the same scale. But crucial takeaways. Asterisk asset ownership asterisk own assets that appreciate, stocks, real estate. Asterisk good debt versus bad debt asterisk asterisk debt for income producing assets can be a tool. High interest consumer debt. Bad. Asterisk long-term mindset asterisk hold for generations. Compounding works, avoid frequent capital gains. Asterisk tax efficiency asterisk max out tax advantaged accounts. Asterisk educate yourself asterisk understand these systems to navigate your own financial journey. Don't be oblivious. So there you have it, folks. The not-so-secret playbook of the 1%. It's not about being smarter, it's about being privileged, having top-tier financial advice, and exploiting the tax code's intricacies. It's a game, and they're playing it exceptionally well, often at the expense of everyone else. Does it make you mad? Good. Use that energy to educate yourself, advocate for change, and build your own damn assets. If this deep dive was both infuriating and enlightening, smash that like button, subscribe, and let me know in the comments, which loophole shocked you most. What other secrets of the rich do you want me to expose? Until next time, stay financially savvy, and don't let the system grind you down. Peace out.